You just crossed over into the Twilight Zone.
Well, greetings everyone and welcome to the Argonaut monthly video covering April 2025 and the first week of May. Well, we've seen a remarkable rebound in markets since our last videos to levels last seen before President Trump's announcement of tariffs in Liberation Day. And you can read our thoughts on this and on the two funds in April in our monthly commentary. But in this month's video, we're going to look at three things. First, what's been going on in global oil markets so far this year. Second, asking the now fashionable question of whether the period of American economic exceptionalism is now over. And most importantly, discuss what now for equity investors after the rally. Now, we've called this month's video the Twilight Zone.
You just crossed over into the Twilight Zone.
Now, last month we talked about the increased attractiveness of gold as an alternative risk-free asset in view of the perception of heightened potential political risk in both using the dollar for trade and holding the dollar in the form of treasuries for investment. And this month we want to talk about another commodity, oil. And for context, OPEC Plus, which now includes both Russia and Kazakhstan, currently produces around 42 million barrels per oil per day out of 103 million barrels oil per day of global oil production. Now, the context for this is in 2022, OPEC Plus agreed to cut 2 million barrels of production, and this was seen as stabilizing crude prices above $80 following their spike to over $100 in the immediate aftermath of the Russian invasion of Ukraine in March 2022. And these cuts were subsequently extended by OPEC Plus to 2025. Now, geopolitically, this was seen as OPEC or Saudi Arabia effectively supporting Russia in financing its war effort, and Saudi Arabia also snubbing the Biden government. But since Trump came to power, there's been a significant change in Saudi Arabian and therefore OPEC policy. Now, on Saturday, OPEC announced that it would boost oil production by another 400,000 barrels a day in June. And this means that OPEC will have already taken back around 44% of the 2.2 million of voluntary cuts it had implemented since 2022. And with more cuts expected in the next few months, it's possible or indeed probable that by November, all of that 2.2 million barrels a day will be back on the market. And this will happen a lot faster than the 2026 deadline that was previously thought. Now, crude oil has fallen this year from about $70 per barrel to $60 per barrel, but the forward curve is now in contango, suggesting a price war this year, but with oil prices being more sustainable towards $70 in the following years. Now, we're told that OPEC's motivation is to bring chronic overproducers Iraq and Kazakhstan back in line, but this to our mind doesn't explain the urgency, which is more likely related to a Saudi-US entente in dealing with Iran, which will also mean that Russia will find it more difficult to fund its Ukraine war and more likely to be interested in peace negotiations. So whilst this will create short-term difficulties for non-OPEC plus oil companies, it will also help oil-intensive industries such as airlines and countries that import most or all of their oil. Sadly, this won't include the UK given our disastrous net zero policies, but it will put money back into the pockets of most consumers.
You just crossed over into the Twilight Zone.
Now, toward the end of April, the first estimate of US GDP for Q1 came in, and it came in at an initial minus 0.3% annualized rate quarter on quarter. So already supposedly reflecting negative economic growth. But on closer reading, this was a figure that was distorted by a 40% rise in imports front-running tariffs which subtracted a whopping 3% net from GDP. Now, stripping this out, Q1 GDP was estimated to be running closer to 3%, and we've seen from other measures, for example, the Atlanta GDP now, which have bounced from minus 3% witnessed during Q1, which was affected by imports, and is currently tracking at plus 1%. So actually, the economy underlying is doing much better than the headline level suggests. Now, Q1 earnings season has so far generally been fine relative to lowered expectations. And if we accept the distortion in the measurement of GDP, the hard economic data, including employment, is still robust. Now, this isn't, of course, a great predictor of the future. It only tells you what's been going on in the recent past. So economists and investors also use surveys where people tell them about their future intentions. But these are also problematic because we've seen, as we commented last month, that the consumer confidence surveys are prone to extreme political biases, and business confidence surveys seem to also have significant regional and industry variations. So it's possible that despite all of the headlines and fears about where the economy will grow, that the underlying US economy is doing much better than what business leaders, investors, and commentators are motivated to see, and that the end of US economic exceptionalism turns out to be something of a phantom crisis.
You just crossed over into the Twilight Zone.
Now, in our last video, Detox, we previously commented on the imposition on April the 2nd of a minimum 10% Liberation Day tariff by President Trump, as well as higher specific rates on countries. But then on April the 10th, President Trump announced a 90-day pause on all reciprocal tariffs above a flat 10%, except those imposed on China, which are currently a whopping 145%. So having lost 12% intra-month, markets subsequently rallied, amazingly back to where they were at the start of the month. Now, it seems unlikely to me that in just 90 days, the US will agree any significant trade deals, perhaps beyond a memorandum of understanding, and so markets should anticipate further bouts of volatility as we approach the July deadline. And whilst business and consumer confidence will likely impact real-world investment decisions. Now, whilst there are some signs of a thawing in Sino-American relations in that Trump has admitted that his current tariffs are unsustainable, amounting to an effective trade embargo, and China has also rescinded some of its retaliatory tariffs, US West Coast port volumes are currently already down 1/3 from their normal size at this time of year. So we find it difficult to comprehend how the business models of the world's first and second biggest economies can change overnight without a schism in financial markets. And we think Trump is serious, and it's an error to dismiss out of hand everything he is attempting to achieve as being ill thought out or an illogical act of self-harm. So we're entering a stage of the economic cycle with mixed signals and a high degree of uncertainty, where the rules of the game are unclear and a multiple of different outcomes are possible. For this reason, we think we have crossed over into the investment twilight zone. So it remains to be prudent and to continue to hedge our bets.
You just